Using hedging to secure a financial future. Illustration. So here we first, in this definition of hedging, we will see why hedging, and we will also go through an illustration of hedging in order to make everybody understand the concept of hedging. So why hedging? This is because of risks such as commodity price, stock price, exchange rate risk, and interest rate. Managers of the organization find that today's business is full of uncertainties. Hence, to mitigate the risk, managers use the futures market. There is a session on financial derivatives where we actually define that. There is forward which is defined, and futures also is defined. So in the futures market, the managers use that in such a way that it would take up some of the risk. So this process is called hedging. So as you actually are aware of this, today's business is a very complex phenomenon. As observed by the organization's managers, the profit of the organization depends heavily on external influences like commodity price, stock price, exchange rates, and interest rates. As a result of which, today's business has grown more complex, risky, and with full of uncertainties. In order to minimize such risks, which is naturally the most important function of a manager in such an organization, they tend to transfer this risk to others who are willing to bear the risk. So this is done by virtue of futures market, who can provide the managers with some of the tools and techniques to control and reduce such price risks. Hence, hedging is defined as the activity of trading futures with the only objective of controlling and reducing risks such as price risks. This hedging is supposed to work well in most of the organization which deals with price risk. So before we explain the details of hedging, we will also try to illustrate this concept of hedging by taking an example. So this is the illustration of hedging. Before we get on with that, we will just see what exactly is this illustration. So hedging, as was explained, is the act of protecting one against future loss. In order to reduce price risk in a spot market, futures trading is made use of for hedging purposes. Hence, in this context, hedging is a position taken as a temporary substitute for another position in another asset. To simplify, it protects the value of an existing position in an asset until it is fully liquidated. So a firm can take hedging whether it is to cover positions on the asset side or liability side of the balance sheet. Hence, this concept we illustrate where we consider a jute mill anticipating a requirement of 1000 jute candies in the month of July. So that is what we try to illustrate here. So our illustration says the jute mill company enters into financial agreements based upon the fact that the jute candy price per candy is rupees 1000 in June, and it tries to procure jute candies in the month of July, where the prices seemingly go up in the months after June. So in July the price is supposed to go up, but it wants to procure jute candies in a price range of rupees 1000, but in July it has actually gone to 1500. So how exactly the company plans such a scenario, or how hedging is used by the company to basically mitigate this risk, this price risk. So what the options left for the jute mill company is that in June, in the month of June, when the jute price of candies is rupees 1000, it purchases jute futures of rupees 1000 to protect the value of an existing position in an asset, which is jute candies. So it buys actually jute futures of rupees 1000. Now in July, what happens is that the price of jute candies have gone up to rupees 1500, and the jute futures price has gone up rupees 1470 per candy. So what the company does, it actually sells this jute futures in the month of July, and it obtains 470 per candy, rupees 470 per candy. So the company is capable of spending about 1470 rupees per candy, and it now tries to procure jute for rupees 1500, which is what is available. So it actually gets the money because of the sales of the jute candies, and it collects that, it puts it for purchasing jute candies for rupees 1,500. So how much money has the company spent overall? Rupees 30 only, because most of the money it has gotten by the sale of the jute futures. So that is how hedging is actually used. Now let us see what is multi-purpose hedging. So this multi-purpose hedging was first proposed by Holbrook. And it actually, what is actually multi-purpose hedging? Multi-purpose hedging allows hedging to be used for all purposes. Now, for instance, in carrying charge hedging, if the spread between spot and future price accommodates carrying cost, the stockist buy ready stocks. So it's a conscious decision as to whether to store as opposed to whether to hedge, which is the conventional approach, which is non-Holbrook approach. Now, what are the different types of multi-purpose hedging? So there are operational hedging, there is discretionary hedging and anticipatory hedging. So in the case of operational hedging, the futures market is used in such a way that it reaffirms the hedger's belief that the futures market is more liquid than spot market. In discretionary hedging, what happens? The traders do not hedge unless there is an adverse price movement in futures. And lastly, in anticipatory hedging, the hedging is done based on subsequent sales or purchases. So these are the different types of multi-purpose hedging. Next, we will see what is long hedge and short hedge. So what is short hedging? In short hedge, the trader involves in a short position in hedges, which would mean it occurs when he plans to purchase or produce a cash commodity, sells futures for that to hedge a cash position. For example, in the decline of a cash price, the deficit is born out of selling futures, which is exactly what happened in jute candy example. Now in long hedging, what is exactly long hedging? The objective is again for protecting itself against a price increase in the underlying asset prior to purchasing in spot or in the futures market. Mostly it will be taken when a firm has to purchase a certain asset in future and wants to lock in for a price. It is also known as inventory hedge. So that is long hedge. And in conclusion, we will just mention what is cross hedging and what is asset mismatch and maturity mismatch. So there are other forms of hedging called cross hedging, which is used whenever futures contract is not available for hedging on the set days, which is asset mismatch. If the futures contract is not available on the set date, it is asset mismatch. It also happens for maturity mismatch, is when the futures period is not available on a particular asset. So for both these conditions, there is the availability of cross hedging, where futures contracts are used as it expires on dates other than those on which hedges are lifted. Hence, it can be said that in cross hedging, the characteristics of spot and future positions do not match well. So this concludes a session on using hedging to secure a financial future. Thanks.